Thank you for having me, Anton.
Yeah, it's a pleasure to have you on. Please fill any gaps that I have missed in my introduction.
No, I think you pretty much covered it.
Okay, very good. Uh, so you are very active in a number of markets in Texas as well as in Oklahoma. So maybe why don't you just tell us what some of the markets you are active in, and we can dig into some of them a little bit deeper.
Sure. I've got a big team behind me. I want to go ahead and get that out there that it's me and um, you know about 12 or 13 other uh, fellas brokers that help me. And between us, we've got about 12 or 13 deals in escrow right now, from Houston, Austin, San Antonio, Dallas, Fort Worth, and up through Oklahoma, a tertiary deal up there, and a couple of deals under contract in Moore and Oklahoma City.
Yeah, that's really a great way of for us to dive in a little bit. It's a very unique situation we have here with you on, John, because in most instances we talk to brokers that are focusing just on a single market, right? And they may not know much about the others. So I think we need to kind of take advantage of your knowledge of multiple markets and what you have seen between these markets over the last 6 months, since we have been exposed to the fallout from COVID-19. So maybe you can give us a little bit of a flavor of what you have seen, how these markets have performed in comparison to each other, and what was good, what was bad with each of them.
Okay, yeah. I think probably what I'm seeing across these markets generally is that rougher properties, I'm talking about older C-class properties. It really doesn't matter if I'm in Houston or if I'm in DFW or if I'm in Oklahoma City. Those are the ones being hit the hardest by COVID-19 as far as collections going. It seems like the well-located properties, with more affluent residents, are able to pay their rent, and those have not been impacted near as much as far as the collections. Because as you know, in the finance business, we're always looking at, or in us, me in investment sales, you in finance, looking at, what is the net rental income? What are proceeds going to be, and how can we get that net rental income up? And what's it been doing over the last 3 months, and what's it going to do next month? That type of stuff. And I've really seen those C-class ones get hit hardest. Um, Now, every market has good pockets. Every market is active. Like I mentioned, we've got some deals going on in each one. I think I've seen a higher kind of bid-ask spread between what sellers think their properties are worth and what buyers are willing to pay in Houston. There seems to be a little bit of a delta there. Um, it's hard to shake folks loose in Austin. It doesn't seem like there's very much velocity there as far as transactions, but we do have a deal under contract there and another one we're working on trying to get to contract. Austin is, I was there the other day, I actually went through Austin and San Antonio. Austin is, getting very, what I would call a lot of tech, right? There's a lot of tech moving there, and it's starting to look more and more like, San Francisco or Los Angeles. There's a lot of, you know, um, homeless population, and they've just had. So we'll see how that kind of affects things there. But there's a lot of cranes. There's a lot of high rises being built there. Um, a lot of high end apartments. San Antonio, I think, is one of our favorite markets. We've got 6 deals under contract there. It's held up the best out of all of them as far as collections, even in those in those C-class properties that I mentioned. I think San Antonio is, you know, just a solid, you're not going to get a ton of appreciation there, but it is a very strong market. Oh, excuse me one second. And then Oklahoma City, has not, a lot of people are not very excited about it. At least they weren't for a while. I'm seeing it starting to pick up some steam with investors, because the rents are still, in the $500 or $600 range there. So you can still pick up stuff at an attractive basis. I'm selling some properties there for 30, 35, 40,000 per unit, which, as you know, and as we've seen in this last market cycle in DFW, those have all really gone away.
Definitely, yeah. So based on the deals that you have been working on in Oklahoma City, so you have not seen a significant difference in terms of collections compared to some of the other markets. I thought that Oklahoma City we would see a little bit of a tougher environment in terms of collections, but that's not what you have seen.
Well, no, if I said that, I misspoke. I hadn't seen it in San Antonio. San Antonio's
okay.
been the solid one. Oklahoma has struggled because these couple that I've got going right now are C class. They're in a little bit poorer areas, and their collections have struggled. Their
Okay.
collections have struggled. In fact, one of them is in Moore, which is actually a pretty affluent suburb,
Right.
south of Oklahoma City, between Norman and Oklahoma City. And somebody went over there and told the residents that they don't have to pay rent and they can't be evicted, spreading misinformation. And, it has hurt the property. So, yeah, if I said that in my last kind of little rant monologue, I misspoke. Oklahoma, like I said, the C class has been hit hard.
Okay, very good. Thanks for that feedback. So San Antonio is kind of of all of them, then, if I understood you correctly, is the strongest one among all of them.
That's right, and that's where I'm seeing the most activity that we have is in San Antonio with these B and C class properties that are maintaining their occupancy, they're maintaining their collections, and the debt's still available. And we're doing one right now that's a loan assumption.
Yes.
So yeah, San Antonio's holding up well.
Okay, very good. Have you seen, apart from obviously buyers trying to push back on prices, right, which is kind of obvious in the current environment, but have you still seen a good flow of buyers competing for the properties? As we know, right, until COVID-19 hit, it was not uncommon to have a very strong flow of offers on every single deal. So what would you say have you seen now since COVID-19 hit in terms of buyer interest, and how much of an impact do you think that has had on the actual pricing?
So yeah, very early on, I'd say, late March, early April, a lot of the buyers were kind of waiting and were on the sidelines. We saw more starting to come back and get comfortable with the new normal in, say, June. And I had multiple offers on the Moore deal that we marketed. We had multiple offers on the Grand Prairie property that we marketed. So, there is still significant, demand from investors. I think it all depends. A lot of it depends anyway on if it's priced right. If the seller is realistic and the financing works and the whisper price is somewhat reasonable, then I think there's deals to be made.
Yeah.
Then like I was talking with just to give you a little story. I was talking with a guy last week who said, "Oh, well, you guys gave me a BOV last year and we're selling it for, I think it was $200,000 more than what you quoted us." And I said, "Okay, well, when did it go under contract?" And he said, "In June." And I looked back at my notes. Well, we'd given him the BOV, last June. And so, I'd say if people are going to, list something for a year, maybe, that's one strategy. Hang it up there at a very high price and wait for that just right buyer to come along. That's
Sure.
that's not how we do it. We are like, hey, we're going to have a call for offers in 30 days. And this is the price where we can get you right now.
Yeah.
So it's a little bit different. So I think to the extent that things are priced correctly, there's plenty of active bidders.
Yeah. Okay. That's good to see. I would say that's only also what we have seen with some of our clients. Why, John, you have been working on a deal in Kylene, and so they came in still pretty aggressive, right? Because they felt that the competition is strong enough that that they had to come in with that.
Yeah, a bit of a smaller property, Class C, a little bit older, but it was a group that felt that it was the right size property with local based investors that felt that it was going to get them up and running. And I think you're right, John. As some of these investors are looking across the larger metros where maybe the demographics had been benefiting the rent growth story. Some of these smaller secondary markets like a Killeen might have a little bit more stable rent and get the cash flow. But it is kind of up to the investor to figure out that execution risk of being able to manage the operating side when the rent lift may not be as strong in a Killeen, and not getting too far off topic into secondary markets, but what do your investors think about when you talk to folks that when you're listing a property that's in a secondary market, how do you kind of think about positioning that opportunity for investors versus when you've got something that's a little bit stronger market?
It's an education process of, and then you've got people who are just closed-minded. They're not gonna look at a deal in Killeen. You mentioned Killeen. We've sold a lot of properties there. They're not even considering it, even though, and they'll look at Waco, but even though, Killeen is bigger than Waco, you feel like there's more of an economic story there. It's, closer to Austin and, and Waco, the market's, kind of struggled here recently. But, it's just things like that, telling them about, why we like the market and, again, attractive basis. Because as you guys know, when rents move from, say, 550 to 650 or 650 to 750, it really starts to push up the price because of the, economics of the, you're kind of, the expenses are similar, and all of that stuff can just go to leveraging more debt, less equity and have a higher, price. So for investors that are looking for low basis, these tertiary markets are a good play. And then, ones that are willing to take a trip out there and go look. I've got a deal right now that I'm selling in Hollis, Oklahoma. 5,000 people live there. And these folks drove out from Las Vegas.
Oh, wow.
And looked at the property, and they're about to start a $1.5 million renovation on it here when we close here in a couple of weeks. So, but that's dedication, right? They found, and they're picking up the property for right around $5,000 a unit because it's distressed.
Yeah.
Yeah. It was an old property my client bought from HUD 18 years ago. So, they're buying that and they're going to fix it up nice, and, they're going to be rewarded for that risk. But certainly, like you mentioned, it's riskier. But for folks that are willing to get in there and, he's going around talking to the city, talking to the business owners and getting a feel for the market. And that eliminates some of your risks just by your own kind of, business acumen and, feeling passionate about a project.
Yeah, very good. Yeah, that's great. Have you seen on the seller side some sellers that have approached you, or prospective sellers that have approached you, where you see a more of a distress situation not just at the property, right, due to collections, but also from a partnership perspective, where they already had a little bit of a struggle pre-COVID-19, but now they are in a tougher position where they have to make some form of a decision whether they want to sell or do something else, or recapitalize or whatever it might be.
I have, there are unfortunate, projects that don't go well. It seems like, from what I'm seeing, if they can, get their equity all out, some are willing to, go ahead and do that, especially if it's a syndicator who realizes they're kind of just working for free at this point, and there may not be a big, payday for them at the end. Yeah. And then, we've got one deal that was in forbearance that we just put under contract in San Antonio. And so that was a situation where, we found somebody to assume the loan, where, they were getting ready to, they'd owned the property for a long time, but they put a big loan on it a couple of years ago, and I guess taking some cash out. And they were either getting ready to have a capital call, or
sell.
Yeah, or sell, basically. And thankfully, we were able to find somebody to assume the loan, which is saving them a lot of money on their, yield maintenance. But yeah, does that answer your question? I think there are partnerships like that. What are you seeing out there? I'm curious.
Yeah, I mean, we monitor all these deals quite closely, right? We also have access to some loan data, and there is only an indication that there are quite a number of deals that are not doing that well. But I think it's still, from my perspective, and John, correct me if I'm wrong, but I think from my perspective, they're still a little bit in a denial phase, where very often the sponsors, particularly in a syndication environment, that they are feeding that monster on a monthly basis because they don't want to destroy their reputation. So naturally, they hope that the situation will improve and then everything will be fine again, right? So that's what I would say. We see quite a number of deals that have popped up more recently. We have always seen them, but there's only more that have shown up now.
Yeah, and I'd add, Anton, that, and John, maybe you might see this with investors, both on, people that are owning properties now, as well as looking at properties on the buy side. But if you think back to the last cycle, I was wearing a different hat at that time, helping to advise dollars that were being distressed invest in different types of securitizations. And, everyone at the time was trying to handicap what type of recovery would we be seeing. And I think in this instance, from hindsight, we can say it did take a while to come out of that, last downturn, back in 08, 09. Going forward, it's kind of hard to know, are we likely to see some type of firming in the economy before end of year, or are we really kind of going to be, a ceiling put on the economy for some window of time, and then from there, maybe we have some lift. And I think that it's pretty challenging for many investors to try to handicap, maybe I need to talk to John because I feel that, my upside from here is only going to, drag my return, and I might need to hand this off to someone else. And, someone else might have the capacity and the capitalization to step into an opportunity, possibly like the property you're talking about in Oklahoma, where they've got a longer term vision, they've got the capital, and they have capacity to see how things play out. But as far as the shape of the recovery, I think that's got to affect a lot of folks, both on the buying and selling side.
Yeah. So obviously I think we all agree we have seen a pickup in some of a distressed or close to being distressed situations for owners compared to pre-COVID-19. What have you seen, Sean, on the buying side, in terms of buyers struggling to raise their equity and or also getting the debt in place that had a negative impact on some of the deals that you have been working on?
Yeah, I have two, examples of that. We were working, actually three. So we had a deal in Grand Prairie called Treetop that I had under contract at the early part of this year, with a real reputable buyer. And when COVID hit, their, equity partner was going, we're not comfortable at this price anymore. We're not comfortable, with the deal really is, because there was so much uncertainty. Same thing with the deal Seven Pines. I've got it back under contract now in San Antonio, but that was another one where, very capable sponsor was in there and had a single check writer equity, partner. And we extended a few times trying to get them comfortable, but at the end of the day, their equity dried up. And then another one was a loan assumption. And that one got so close to getting done. But again, the equity partner pretty much at the last minute stepped away. So it's been, there's been real effects from this pandemic on, equity.
So all these three were driven by equity pulling out,
Right.
but not the debt itself.
That's right. Yeah, the debt, is held up pretty well. And, you look at, you mentioned, or we were talking before this, before we started here, about, the P&I, the additional reserves for these agency loans. And, it seems like people are getting more, used to the idea of those, and and when you look at the underwriting with them, it doesn't affect the returns that much. If they come back, relatively quickly, and you kind of structure it right with your LPs, so I don't think the debt has been the issue as far as agency loans. Now,
right, yeah.
On my bridge and some of my tougher deals, this one I have, Arbor Vista in Oklahoma City, has been under contract for 4 months, and we just got the bank. The mortgage broker shopped it for a long time. This borrower was very particular about these terms he wanted. Finally found a bank willing to do it, and it took them several meetings and several, committees to get it done. So it's just taking longer, more challenging for you guys to go out and find on those
Sure.
bridge or bank loan products.
Yeah, that's definitely the case, right? A lot of the bridge lenders, they close shop, right? And the ones that are still active, they are very picky, right? They have more deals than what they can fund, so they can pick and choose, right? So that's unfortunately when it comes to the heavy rehab projects, that's really what a lot of buyers face. Also, like in the past, it was kind of easy to get bridge financing for management plays, not really through physical improvements to the property, but more because the management was not really professionally run. These type of deals are really hard to get bridge financing in place, because bridge lenders do not believe that anyone can come in and turn it around just by changing management, right? So it depends a little bit on what kind of situation there is, but it's definitely much harder. Yeah. Yeah. So maybe to close out, what I know you don't have a crystal ball, right? Nobody has it, but what's your view with obviously the federal unemployment checks for $600? They expired at the end of July, and some states we know have implemented at least $300, and but I think in Texas Texas is not contributing the additional $100. So essentially we are down to $300 from the 600. So I think that, from my perspective, should have a negative impact on some of the tenants' ability to pay rent. So short term, I'm wondering what your view is, and then also what you think is your outlook looks like into 2021.
You know, I don't know. I don't know short term. I don't even really have a prediction. I think, well, I guess maybe go back to my original thesis. Well-located deals with residents who can work from home, whose jobs, may not be as impacted. Those deals are going to be fine. And then, your tougher deals where maybe you have folks that might try to take advantage of something like that, or just flat out can't pay the rent. Those collections are gonna suffer. With less money, there's going to be less collections, unfortunately. Looking beyond, this year, we've got the election coming up. I'll be watching it with with interest, just to see kind of how everything falls, and it'll certainly be interesting to watch the upcoming debates. But we're in a great country. We're in a great time in human history. Human beings are resilient. We seem to work together relatively well. I think that from everybody that I see, who's out there just trying to work together to make deals happen, keep food on the table, and keep moving forward and enjoying life. I think 2021 will be a lot better than 2020.
Yeah.
That's my prediction there. We seem to have come to the realization that we're going to live, coexist with this virus. And if folks will, do their part to control the spread of it, then the economy can still function, even if it's at a slightly lower level. Rents can get paid, and investors can invest, and guys who are in the middle, like me and you and John, can continue to make a living and help people navigate through whatever challenges come.
Yeah, that's all very good points. I think if I can summarize of what you have said, right? Now it's more important than ever to pick the sub-market, right? That you really understand what you're getting into, right? Not just looking at here is a good price on a per unit basis, or here I have only $500 or $550 in rent, but also recognizing what the true upside is, rather than what might look good on paper, right?
Yeah, that's it.
Yeah.
The harder markets, what we saw, and John mentioned it, the last cycle, we're talking the Great Recession, what we saw there was most of the deals in the C class were financed with CMBS debt, and a lot of those went back to lenders, and that's where the majority of your distressed properties came from. It wasn't from A class or B class. It was from, folks that doubled up or went back to live with their parents and just couldn't pay the rent. And so people lowered their standards and the property cycled down. And it's the same situation today. The worst properties, I feel like, are getting hit the hardest.
Yeah. So it's very interesting for you to say that, right? Because we like John and I, we talk particularly a lot of syndicators, and many of them always have an argument: C class and even C minus properties will always be full, because you have that trickle down effect. People from A class move to B, and from B they move to C, and C minus. I share your view, right? Because I have been around long enough to experience the past downturns, including in 2000, from 2008 to 2011, when we really have seen the toughest fallout. And I think that's what one has to recognize, that yes, there might be a move from A to B and maybe B minus and maybe some from B to C plus, but there is a big jump, even if you live in a B class property today, to move into a C or a C minus property, as well as C minus submarket, right? So
yeah, and if my B class property is going to offer me a concession, to stay,
yes,
then I'm not moving down to C. I've effectively reduced my rent, or they offer me the same rate,
yeah,
yeah.
yeah,
Yeah, I think to a certain extent that I've heard that argument too, that, workforce housing. I agree that, affordable housing, which means not, at the lowest level, but for teachers, police officers, nurses, that is affordable housing, right? And
yes,
especially in major metros in Texas, that's always going to be a safe bet. Your properties that have some amenities in a decent neighborhood that's safe.
yeah.
But it's the rougher properties that seem to get hit the hardest.
Yeah, yeah, I agree. Really appreciated all your insight, John. So how can viewers and listeners reach out to you?
Probably the best thing is my website, which is www.multifamilygrp.com.
Okay.
I've got my phone number and email there.
Very good. And I know that you're active on LinkedIn and the other social media, right? So it's very easy to reach out to everyone in today's world, right? And with COVID-19 now, everyone is so used to to communicating through various electronic means. So that's great. But we certainly are looking forward to meet with you in person very soon again. And thanks again for coming on, John.
Thank you both for having me. I appreciate it.
Thank you.
Thanks, John. Thanks, Antoine.